Good evening, everyone. Greg McDermott with Cyber Trading University, welcoming everyone to our Options Advantage free webinar. We appreciate you joining us this evening. We are going to get right started just so we can talk to you as much as possible about this great Options Advantage program that we've got at Cyber Trading University. First, let's go over the nuts and bolts, the things you got to get out of the way, our risk disclaimer, and about Cyber Trading University. CTU has been an educational trading institution since 1995. CTU established itself as a leader, first by working directly with the SOES trading firms to teach them to day trade. CTU was one of the first to establish itself as a quality stock market trading school. Each of our instructors, including myself, has a minimum of 6 years of actual trading experience before they begin to work with students. Over the past 14 years, we've taught thousands of students to become successful and profitable traders, and the CTU headquarters located in the heart of the trading world in New York. That's me. Earned my master's degree of applied finance at Macquarie University in Sydney, Australia in '89. Bachelor of Science in Financial Management from St. Joseph's University in 1987. I was a crude oil options trader at the New York Mercantile Exchange. I was the head options market maker for JAS Securities at the Philadelphia Stock Exchange. There I managed the firm's portfolio risk for a team of 10 options floor traders. I was also a market maker in the Dell computer crowd at the Forex. At the time, 20 years ago, Dell was the busiest equity option traded in the U.S., directed our all-floor trading unit for JAS Securities, and at the time was qualified by the ISC as a DTR. And that's all the requirements. Let's get to the good stuff. Why trade options? And I'm hoping that's why you guys are joining us this evening. And hopefully we've got a lot of people on who are interested in learning about options. We're going to talk specifically, use our examples around equity options, stock options, but almost all of the things that we're going to talk about tonight pertain to, say, options on futures, options on Forex, all of those things. The basic principles of options will apply regardless of where you use them. We're going to use stocks as our advantage. I'm guessing as our vantage point. I'm assuming that most of you come to us from a background of stock trading, so the transition and the understanding of trading equity options or stock options should be relatively clear for you. We're not going to talk about what are calls, what are puts. I'm going to assume, I'll give a quick overview, but I'm going to assume everybody on the call is familiar with calls and puts. We're going to talk about more of the advantages of why you'd want to use calls and puts for trading. And just we'll go over briefly what is the call. A call option gives the buyer, the owner, the right but not the obligation to buy a specific stock, in this case, at a specific price until expiration. What does the put buyer have? They have the right but not the obligation to sell underlying security at a specific price until options expiration. So that's the quick definition of what a call and what a put is. We're going to talk about why you would want to add trading calls and puts in your as part of your trading plan. I'm a big believer in trading options. As you can tell, I've done it for a very long time. I think there's some enormous advantages that you may or may not be aware of. A lot of people, if they're unfamiliar with options, immediately say one of two things to me. They'll either say, well, options are too dangerous because I heard Warren Buffett call derivatives or options, the weapons of financial mass destruction. And, they can, when used incorrectly, can put an individual, a firm, an economy for that matter, at risk. But we're not going to talk about trading that way. And the other thing that people will say to me is, oh yeah, what I do is I just, I've heard that, most options expire out of the money, so I don't buy them because there's no way to make any money. Both of those things overly simplistic and clearly incorrect. And we're going to talk tonight about why those two things are incorrect. So let's get right to our topic. What we're going to talk about, what are the topics of the conversation this evening? We're going to talk about the capital efficiencies afforded those people who trade options, in this case equity options. The ability to work with limited loss or risk reduction when working with options. A superior alternative to shorting stock. And when I say superior, I mean superior. Additional means to profit. Greater choices in movement. Without movement, there are still ways to trade and design strategies within options to be able to profit. Positive integrity after, position integrity after profit taking. And that is probably one of the greatest benefits of trading options, is that you can remain in control the same amount of an underlying stock, have the position go your way, take profits, put them in your pocket, and continue to control the same amount of stock with some very, very easy, simple strategies. Timely and flexible portfolio protection. It allows you, the owner of options, or in some case the seller, but more often than not the owner of options, to build protection, whether it be for a specific underlying stock, or maybe you're trying to protect a retirement portfolio. And there are strategies where you can choose the amount of money you want to spend. You can choose the way that you want to go about trying to ensure and mitigate the loss possible in your individual stock or in a portfolio. There are ways that you can generate income with trading options. This would involve, more often than not, the selling of options, but those would be in a very structured, controlled environment. You're not going to hear me talk about trying to sell large numbers of out-of-the-money options because as an income-generating strategy, because although in a very short term in a specific stock for a specific month of expiration, that may be a profitable trade, repeatedly doing that does open yourself up to a significant amount of risk. And in fact, most brokerage firms make it very difficult, if not impossible, to allow you to start selling what we would call naked or uncovered options, whether they be calls or puts. And the other thing, take the market noise out of your trading. It's very difficult sometimes to focus on your position, focus on your trade when you hear things in the market, whether they be specific to your stock or stocks or just the market, overall market in general. And the ability to have a little bit of patience, the ability to wait for the opportunities to present themselves, the ability to cancel out what may just be noise in the market is a great benefit and a great tool to trading options. Let's talk about the first, and it's capital efficiencies. I really think this along with position integrity are the two key features, along with risk mitigation. And what do I mean? Let's give you an example of what do I mean by capital efficiencies. We all have a limited amount of capital to trade with, some more limited than others, but at some point everybody's only got so much money that they have to trade. And let's say, for example, you wanted to buy, as an equity trader, 100 shares of our fictitious stock XYZ, currently trading, offered at $100. Now, you can imagine some of the more popular stocks that are trading now, let's talk about Priceline trading, I don't know, over $1,300 a share, or Google trading, I don't know, about $590 below. I think the last time I looked, I hadn't looked today, $590-ish plus or minus, but those are very expensive stocks. So if you imagine this example and then multiply it out by trading some of those higher dollar stocks, you can imagine what an advantage options can bring you. That said, let's go through this example. And I want to be clear, we're not saying that you should only look to trade expensive stocks because of the ability to leverage your positions. That's not it at all. But what I am saying is the fact that you can reach for, example, a Priceline stock at $1,300 plus a share, I think will allow you to expand your horizons. And again, when you're talking about trading options, particularly on equities, we're not talking about what we would all call sort of day trading options, what you see the team at CTU doing so well. This is really trading options for those who are looking to be more, I guess you might want to call it a swing trader or a little bit longer term trader, whether it be a few days into a week or so, maybe two. That's ideally what you're looking for. So in our example, buy 100 shares of XYZ stock, $100. What's that going to cost us? It's going to cost us $10,000 in our account. But again, we control 100 shares of stock. Or if we buy one January 100 call for $10, now what does that give us? We talked earlier, that gives us the right but not the obligation to buy XYZ stock paying $100 from now until January expiration. What's that going to cost us to have that right? Well, one call times 100 times the $10 price equals $1,000. So we get to control the same 100 shares of stock for $1,000 versus the $10,000 capital outlay for XYZ stock to own it. That means you're getting to buy and control the XYZ stock at a 90% discount. So you get to control the same amount of stock for significantly less money out of your account to get to own this position. Now, some of you are saying, yes, that's true, Greg, but you own XYZ stock theoretically forever once you pay $10,000, but you only have the right to own the XYZ stock if you buy the call until January expiration. Correct. Fair enough. It is true. You do only have that you have the right until the options expire. So there is a time limit and a time factor. Options expire. They do go to zero. They do go to parity, which would mean their value plus or minus the strike. So there is a time limit. The time is always ticking. So you do have to balance the need to have the move that you perceive to happen within the time frame that you own the options. And we'll talk about some of the ways that you can do that. So if you save $9,000 when owning or controlling this 100 shares of stock, you could deposit that money in a money market account to earn a minimal amount of interest, returning the interest to yourself. You could invest the options in other companies. You could expand your portfolio and maybe own and control other companies' stock with that additional $9,000. And you could also utilize it for alternate investments. Now, I do want to be clear. Just because you have the ability to leverage your capital does not mean you should necessarily do that. You still have to make wise trading decisions, come up with, in this case, equities and equity options that you want to trade. You shouldn't, just because you have, in this case, $10,000 available in your trading account, get every penny of that $10,000 to work immediately. It's one of the mistakes people make. They overtrade and trade too big, put too much at risk on any particular trade. I mean, for this trade, if your total capital investment is $10,000, you've got 10% of your entire portfolio at risk on this one stock. So we're going to talk about that coming up. So let's make sure that you understand there still is risk management involved to get this done. So let's talk about, and we're going to use this example more than once, two different scenarios. For scenario one, you have a stock position and the stock costs you $58.53. In scenario two, we buy the October 55 calls and we pay just $3.90. So let's compare those two positions. Two things happen at expiration. In our one, the stock closes at 60. In the other example, the stock closes at $55 a share. So let's walk through this scenario and see what happens in these two examples. Again, the stock currently trading at $58.53. We can either buy the stock outright, 1,000 shares, or we can buy 10 October 55 calls, paying $3.90 for each of those calls. And then let's see how that works out at expiration with the stock closing at 60 or $55. Well, we paid $58.53 and at expiration sold it at $60, therefore returning about 2.5% on our money. Our October 55 calls in this case paid $3.90, sold them for $5, and returned about 28% on our investment. So options do provide leverage. But the question we're asking is option leverage always a good thing? You could probably tell by the way I leaned on the word always that it may not be. So the question we're asking is, just because you can use leverage, does it mean you should always use leverage? And we're going to look at that. In this case, you had a higher percentage return on your investment when the underlying stock went your way. But in this scenario, we pay $58.53 and this sold the stock for $55. Well, that's a 6% loss of our investment. But from a percentage standpoint, October 55 call position, we paid $3.90. They're now worth $0, which means we had 100% loss of our investment in those October 55 calls. Please do note that the cash difference, although the percentage is significantly higher, the cash difference is not that much different because we lost $3,853 on the 55 on the stock, and we lost $3,900 on the call. So very similar in a dollar outlay, but our dollar outlay was protected because with the calls, all we could lose was $3,900. Although we could lose from a percentage standpoint 100% of our investment. Don't let the ability to manipulate numbers have you believe, and people will do that, saying, oh, you could lose 100% of your investment. Yes, but 100% of what? I had someone tell me once that, oh, well, every time I trade this stock, every time I buy calls in this stock, the stock goes down. And I asked them, how many times have they done it? And they said, well, once. And I said, okay, so you're correct every time, but your every was only one time. Your sample's a little bit small. So although in this case it does look like worse to own the call just from a percentage standpoint, make sure you dial it down to dollars so that you understand exactly what is really at risk and what are you really going to lose. All things equal, probably loss on decay if renting, but can still win if the price levels of the options rise. So you can still win even if in necessity it goes against you. And one of the things I talk about, and I like to talk about, is it'll come up here. I like to think of options. Well, first of all, I like to think of trading stock as like a two-dimensional way to make money, and the options give you a third dimension when it comes to the options pricing model. We're going to talk about the ways that those can benefit you. So leverage is something that works both ways. Someone gave me an example a very long time ago, and they're right. Water to a very thirsty person, a glass of water to a very thirsty person is a much appreciated and needed thing. But water to a person at the bottom of a 40-foot pool, maybe not the best thing you would have if you were in trouble. So water can be good, can be bad. Leverage, it can be good, it can be bad, like most things in life. Let's talk about the limited loss and the risk reduction. Yes, the risk reduction built into those who trade options. The stock that we just talked about was trading at $58.53. And then you wake up tomorrow morning and find out that not only does XYZ stock not cure cancer, but it gives cancer to everyone who has ever owned the stock. Obviously a ridiculous and extreme example, but it goes what we would call Enron on us. The stock position that we had, because we owned 1,000 shares of stock, was $58,000 $530 of exposure. That's how much money we had tied up in the stock. That becomes our risk. The call position has a total risk of $3,900 because, why is that? Well, we owned 10 calls, so it's 10 times the 100 shares of stock times $3.90 gives you $3,900. And it's the beauty of the options. When you buy, again, as an owner with the right but not the obligation and with calls to buy or puts to sell, your brokerage firm's never going to come back to you and say, well, Mr. Trader, Miss Trader, you own that call, but the stock's way below your strike price, so we would like some more money. And it's the beauty. You know going into this trade, in our example, that the most you can lose is your entire investment of $3,900, regardless of where the underlying stock goes. But if you own the stock, and I'm not saying that every stock's going to go Enron, but it could, and if it goes to zero, you are on the hook for the entire amount of your portfolio of that stock. In this case, $58,530. We already laid out what's the most each scenario could lose. And again, it's the full investment. You are on the risk, and it's one of the misconceptions. People think, oh, well, I'm okay because I have, stocks don't do that. I'm okay. Stock market doesn't go down. And again, it's that two-dimensional view of of trading with the stock market. Up is good, down is bad. We're going to talk about that coming up. Options provide significant protection, the ability to have the right but not the obligation. Now, if you're the seller, you've obligated yourself. You've traded your right for a payment. Therefore, you have the obligation to fulfill that contract. So it can work against you if you're the seller of the call and the stock rockets, goes higher. You can be in a position of a nearly unlimited risk. So with long options, you have limited risk. And when we're talking about strategies with Cyber Trading University, we're talking about the buying of options or the buying and selling of equally weighted spreads, so that you never put yourself in a position where what we would call you are naked short puts or calls. That's a position where you put yourself at jeopardy of blowing out your account. Trust me, I've had enough guys, women work for me who have done really dumb things and put themselves in a position where they can lose money and have. Being the net owner of options puts you in a position where you can pretty easily quantify your maximum risk. That's really all you have to worry about is what you're invested in the purchase of those options. You're also immune to the risk of stop orders, and it allows you to avoid catastrophic events. Let's think about the example that we just gave. Let's talk about the people who owned that stock at $58.53, and they went to bed tonight thinking, well, I'm okay because I have a stop in at $50, and that means I get to sell the stock at $50, so I should be fine. Well, what you'll find is, and let's see if I can grab a pen, and let's try to draw. If you have a stock that's trading at $58.53 and you have a $50, so I can change the color a little bit, choose pen color, there it is. You have try that again. You have a $50 stop loss order in. And again, we determined that for whatever reason, your stock opens, the first print tomorrow morning when the stock reopens, it prints at $10. And then the next print prints at $9.95. If you have a 50 stop limit order on the book, protecting your stock that was at $58.53. Where do you think you get to sell the stock when we find out that this company is in collapse? Most people believe they get to sell the stock because their stop loss order is at 50. They believe they get to sell it right here. Those people would be incorrect, because what a stop loss order is, it is a standing order that says when the underlying, in this case, the underlying stock trades at or below this 50 level, make my order a market order and sell it at the best possible price. Well, in our example, the first print is at 10, which is clearly below 50. So now I have a market order, and that market next trades at 995, so I sell it at 995, locking in almost a $50,000 loss. Well, if you had, again, so you're on the hook for $50,000, but if you had a 50 put, if you had a 50 call, again, that cost you a total of $3,900, regardless of where this goes, no matter how far down your stock goes, all you can lose is $3,900. So it protects you when your stop loss doesn't. It's one of the great weaknesses of a stop loss order in the equity market, because the market closes every day. And as we know, it always seems like the really bad news, or good news if it was an upside trade and you were short, always seems to happen when the market's closed. So that's when your stop loss orders, whether they be on the upside or the downside, are not working for you. It's one of the beauties, in fact, of trading the currency market, because it allows you a little bit more risk management, because the currency markets in the U.S. open Sunday evening Eastern time about 7 or 8 p.m. and they close Friday about 4 or 5 p.m. In the interim, they're always open. They're always trading. So your stop loss orders, although there may be a little bit of what we would call slippage in any one stop loss order, the market is open and you can hit the next bid or take the next offer depending on what you need to get your stop loss executed. It really works as a full-time position hedge. Owning those calls means that no matter what happens, in our example, you're always protected from a catastrophic loss. It works for you 24 hours a day, 7 days a week, until those options expire. At that point, again, then you would have to find another way to enter a trade or hedge your position. So let's talk about the superior alternative to shorting stock. Most of you are unfamiliar with even the concept, the idea of being able to shorting stock, because what happens most cases, people in the stock market believe, incorrectly, but believe that you always buy stocks, you own stocks, the stocks go up, that's good, stocks go down, that's bad. And it does really only give you half of the playing field. There are lots of people who are out there making money and profiting on being short stock. So I think it's something you need to consider. And the alternative is really advantageous, rather than being someone who is out there just being short stock, using put strategies, call strategies, option spread strategies to allow you to be short stock is a much better way to make those position decisions. And what's going to prevent you from being short stock? Well, margin requirements. A lot of brokerages require a significant amount of reserves in order for you to short stock, because if you short a stock, there is the possibility that the stock could go Buzz Lightyear. It could go to infinity and beyond, and that loss would be ultimately held by the brokerage firm if you were unable to cover those losses. So that's why they minimize, and some won't even let you short stock because of the risk parameters of being just simply short a stock. There are also SEC rules where investors make it difficult to place trades. There are ways to get around the uptick rule. Again, the uptick rule prevents you from hitting stocks on a downtick. It does allow you to get around these if you wanted to trade options to get short in situations where it otherwise may not be able to be done. And good, and some brokers, like I said, some brokers just will not allow you to be short stock. I've said it before, but shorting stock, there are people out there that believe shorting stock is the movie equivalent of rooting for Ivan Drago to beat Rocky. It's like un-American to root for stocks to go down. But you have brokers that will not allow you to do it because of all the things we've talked about, in particular the theoretical unlimited risk that you put yourself in if you put a short stock position on in the market. Yeah, and we talked about this, that unlimited upside risk. That's the thing that worries investors most. If you're trying to get short a stock, that the risk of unlimited loss to the upside really scares people away, and it really shouldn't, because there are plenty of ways with options for you to take advantage of downward moves in the market and profit with proper technique. It's not the risk that you may imagine it to be. So I think it's something that everybody should do. I mean, I think shorting stock is being short a position is no different really than being long. It's if you've done your due diligence, you've done your chart work, you've done whatever intelligence gathering you use to make a decision about stock, you shouldn't then say, well, I've done all this work and this chart says down, but I can't play on the downside, so I'll just sit on the sidelines and wait for the stock to go up. Now, in a time where markets are going up, it's a little bit easier to find those up trades, but at some point, we're probably going to get down below this 16,000 level in the S&P, and this is going to be something. I'm pardon me, with the Dow, and this is going to be something where being able to be flexible enough to trade to the downside could be to your advantage. And the final thing is, most people don't understand that to be short a stock, you have to have someone who is the owner of the stock willing to lend you their stock for a fee to be short the stock. So you can't just sell the stock, but you can always just buy options or buy put spreads, sell call spreads, regardless of how many are available in the market. You can have, in theory, almost an infinite number of options where there's only so much stock that's traded. And it's one of the things people don't understand. You can't just be short a stock. You do need to find someone who is long the stock to lend you the stock for a fee in order to short it. When I traded Dell Computer many years ago, there was a term, it's called hard to borrow. And that's when there's not enough open ownership of the stock to allow people to borrow and short it. And that becomes a stock that's called hard to borrow, because there's not enough stock. There are more people who want to short it than own it and are willing to lend it. And Dell Computer was one of those. And in the course of my position, I was short a lot of stock against my options position, balanced out pretty evenly. And one day, we would have every day that the nice woman Michelle would come down and say, "Hey guys, there's 100,000 to buy. We may need to take in 100,000 shares of your stock and call it in." And one morning I came in and found that they had taken away 10,000 of my short shares of Dell Computer, which meant on the opening bell, or prior to the opening bell, I was long 10,000 shares more than I thought I was going home the night before. Luckily for me, the stock opened up. I was able to reestablish the short position and get out of the trade with a profit. But the gentleman who was the principal owner of our company took the opportunity to, we worked with a brokerage firm called Spear Leeds and Kellogg, who eventually became a part of Goldman Sachs. And Jeff took that opportunity to, and I'll leave out all the colorful words I know he used, pardon me, to make it clear to anyone and everyone at Spear Leeds that they were never to take any of his fill-in-the-blank stock again. And after the tirade that he went on that day, we never had to worry about anyone ever pulling our stock in. Jeff was able to make that go away. So you got to remember that to be able to short stock, you got to find it, and sometimes you can't find it. And this allows you to, using options, there's many ways that you can get short and profit from a down move in an underlying. With options, like I said, you can eliminate all of these concerns. Just a quick note, how would you do that? How would you play the downside on it? Well, you could simply buy puts in the money, out of the money, or at the money, which would give you the right but not the obligation to sell that underlying stock. So when it went down, you'd have the right to sell it at a price higher than where it was trading now, for example, profiting on that difference. You can also build spreads where you could do buying put spreads, selling call spreads, and be able to gain value as the underlying moved down. Let's talk about additional ways to profit, giving you greater trading choices. The ability, the flexibility to trade a bull and a bear market with the purchase of calls or the purchase of puts, or using hedged bullish and bearish strategies. You've got lots of opportunity, and again, you're not only restricted to the upside move. You got the other half of the playing field to play in now that you can profit if your underlying moves down. Again, simple purchase of a call for an upside move, or the purchase of a put for a downside move, or using hedged bullish and bearish strategies. Now, there are some strategies out there that you can talk about that are probably a little too advanced to get into right now, but there are ways that you can build strategies that allow you to profit. But the most important thing being, we would always be talking about strategies that are hedged, where if you look at the net overall position, you are not net short options. And I would be very careful if you find someone out in the marketplace trying to teach you about options trading who suggests to you that, oh, well, you can just sell out of the money calls, or you can do ratioed spreads because you want to develop put a credit into your account. I do want to caution you that although I like doing and I have done out of the money credit spreads, I've even done in the money credit spreads, but be careful for those people who may say to you, or lead you to believe that the simple fact that a spread generates a credit in and of itself makes that a trade you want to do. I would argue that that is not the case. Just simply being able to generate a credit, what does that mean? That means you're selling an option and buying an option. The option that you're selling is more expensive than the option that you're buying, therefore generating a credit to your account. The simple fact that you can generate a credit is not in and of itself the criteria for a successful trade. You could build a trade where you could be long one call and short 4 or 5 out of the money calls, turning that into a credit spread, but putting yourself possibly at enormous risk. I was at a trade show out in Las Vegas a number of years ago, and I sat in on a seminar, a webinar that someone was doing, and they showed this trade whereby the trader would have bought one slightly out of the money call and then sold 2 significantly out of the money calls above that in the same month, thereby generating a credit but opening up the possibility to make some profit. And I turned to the nice lady sitting next to me and said, I wouldn't do that trade with their money because of the risk involved. So we're talking about hedge strategies that allow you to profit in a moving market. Also, options. We talked about that third dimension, the 3D effect of options pricing. You can trade the lack of movement in stocks via specific option strategies. Stocks do tend, and I'm sure you've all seen it, have a tendency to move sideways, sometimes for a very long period of time. And there are ways to put on trading strategies that allow you to profit from the lack of movement. And as we all know, if you own a stock, the only way you profit is if the stock goes up. But you can, in a sideways market, in a quiet market, in a summer market like the market that we're trading in right now, you can trade the lack of movement, put that to your advantage, find strategies that allow you to generate some income. For example, we've been talking in our cyber group, which is available to everybody to join. The cyber group with Cyber Trading University allows you to join. It's a $29 promotional for 10 trading days. And when I go in there during the lunch hour, we talk about options trading as well as FX. But one of the trades we've been looking at is over the last 2 weeks. Now we're moving towards expiration this Friday. We've done some out-of-the-money credit spreads trying to play the fact that we have lack of movement in the market. It's sort of has been a quiet market, and we're moving towards expiration relatively rapidly. And we did some spreads where we were able to take some profit and simply allow the passage of time to work to our advantage. So even in a quiet market, there's money to be made as an options trader. And volatility is something that you can trade. It's the wild card piece of the options pricing model. It's the one that really is as much art as science, determining what the volatility of an option or is. But you can trade volatility as if it were a commodity. In fact, they have the volatility index, which some of you may be familiar with, the VIX, which gives you the ability to trade volatility as a sort of a commodity. You can trade volatility irregardless of the movement of the underlying stock. Volatility can be up, volatility can be down, and this price of the stock can be the exact opposite. Not always, but could be the exact opposite of stock could be up and volatility could be down, which happens a lot. Stock goes down, volatility goes up. So they can trade independently, but sometimes inversely. So you can trade that piece of options pricing simply by developing trading spreads that capitalize on difference in volatility or the passage of time, which can work to your advantage. And there's the last piece, just the simple passage of time. Option premiums decay. You buy an option today, and all things equal, it's worth less tomorrow. It's just the simple way that options are designed. They do have a clock. They do have an expiration date. They are ticking. Like the milk you know will go bad at some point in your refrigerator, the options will expire. And hopefully you can profit on those before they expire. But there are ways to develop strategies that allow you to profit simply from the passage of time. I'm sure some of you on the call may have heard of straddles and strangles. Well, there are trades around those butterflies and condors that you can build that can protect from an extreme move, but allow you to profit depending on the way you structure the trade from the simple passage of time. Going from today to tomorrow allows you to put theoretical profit, or push you towards a theoretical profit in your trade. It's not something you can do trading stock. Simply owning a stock from today or being short a stock from today till tomorrow in and of itself does not cost you money or make you money. There are ways that you can allow the simple passage of time to be a profit generator for your trading strategies. We're going to talk about position integrity after, and I said after, profit taking. There are many ways to reduce or modify your risk once you have established an initial position. So if you buy an option, a put or a call, or you buy a spread that you paid whatever price for, there are many ways for you to modify that position. Sometimes I like to call it, sometimes you'll want to leg into a position, which means if you're going to do a spread, you buy one leg or one side of a spread and then wait for some period of time and then do the opposite trade. There are ways to roll a position where you're at a certain strike price and you move, say, up or down depending on where the underlying is going, allowing you to keep the same position, keep the same 100 shares per option contract on the table, but take money off. And again, it seems simple, and it is, but working around the basics, and we teach that here Cyber Trading University, once you get familiar with how options work, then this becomes almost second nature to you. It also allows an investor to change their opinion given the ever-changing market conditions. So you're not locked into, well, up is good, down is bad with the stock market. How many of you have owned stock and, if you had been able to, would have liked to have been able to short that position? Well, it's relatively easy to work around a position and convert it from one to another. You can do it via position modification. The other advantage you have is the cost efficiencies that to keep you psychologically flexible. You don't feel like you're boxed in where I can only make money if the underlying goes up. There are ways to take a simple call or put purchase and turn that into a spread that may be the exact opposite direction of what you intended when you got into the trade. When you think about full stock trading, round trips can be expensive, and there can be tax ramifications trading the stocks rather than trading the options. The ability to have this flexibility, keep a psychologically clear head, can help remove a lot of the fear of loss while allowing your profits to run. And that's the key. If you own 10 calls and the stock goes up $5, you can sell those calls, maybe buy a strike or two up calls, still have the same 1,000 shares under your control, but have taken some profit and put it in your pocket. This can't happen because, as you know, if you trade stock, the only way to make any money if you're just trading stock is to sell your stock. And if you had 1,000 shares of stock and then you sell it, you then have less than 1,000 shares, and you may even have zero if you had to sell the entire position. But in an example, if you bought a call, and it cost you, say, $3 to buy a call, and you bought 10 of them, and for whatever reason the underlying goes up and those calls are now worth $8, you could just sell the calls out and take a $5,000 profit. But what you also could do is, and I'm making up an example, let's say that the calls you paid $3 for were the 50 strike, and the stock, it goes up, and now that's worth, and now the 60 calls, we bought the $3 calls, the 50 strike, stock goes up, and now the 60 calls are $3, and our 50 calls are worth $8. And again, just an example. Well, what could you do there? Well, I'll sell the 50 calls at $8. I'll buy the 60 calls. I'll pay $3. And what has happened to my position? What do I have in front of me? Well, I now own the 60 calls that were trading at $3, but I've already taken $5,000 in profit. So I've put $2,000 in my pocket. Again, I originally paid $3. I sold them at $8. That's $5 profit, but I then paid $3,000 for these calls. So now I have my $5,000 that in profit. I have $3,000 of it tied up in 10 calls, and I have $2,000 of it where I like it, in the bank. So I still own or control 1,000 shares of stock. My strike price that matters to me is now 60 rather than 50. I have $2,000 in my bank account, in my margin account, and I still have $3,000 at risk. And if these calls go up and they go to $5, I might just say at that point, okay, sold. I sell them at $5, and then I make $5 plus my $2 gives me $7 or $7,000 if you multiply it out times the 10 profit. So I'm not saying it's that simple, but you can take profit and still control the same amount of stock very, very easily. Timely and flexible portfolio protection. You can simply, if you own a stock or you own a portfolio of stocks, you can go out and buy a put to protect your downside exposure. Let's say you work for General Electric, or you work for Google. What the heck? You work for Google, and all of your retirement money is tied up in Google stock. You're at risk for Google if someday we find out that Google is not the greatest thing since sliced bread. I don't know if that day's ever going to come. I may not live to see it, but let's just say, well, what could you do to protect, let's say for whatever reason you can't sell your stock. Let's just make that part of our equation. For whatever reason you own the Google stock because you work there, but you can't sell it. Well, one of the things you could do is go out and buy a put at some point in the future that gives you the right but not the obligation to sell that stock at a certain level to mitigate that potential loss, because puts gain value as stocks trade lower. So let's make a number. Let's say you bought the 500 puts in Google. God forbid it trades down. You know, you could always sell your stock at $500. That would allow you to protect the investment that you have in the stock. And a lot of times you can build a portfolio where the put profit can offset the loss in, for example, in your Google stock. You can also just roll it out and say, hey, I've got a portfolio that I determine is perfectly correlated with the spiders, the S&P ETF. Well, what could you do there? Well, I'll just buy some spider ETFs, and if my portfolio that is long or positive spider exposure goes down, I would lose money on the portfolio, but I could gain money on my hedge, offsetting some of that loss. Again, just a quick example of the protection strategies that are out there. And you also have the advantage of, by simply closing out your put position, your original stock position or stock portfolio position is still fully intact without any tax ramifications for those particular securities. This also, I'll remind you again, is superior to those unreliable stops. Let's take a look. Simply by closing out your protected position, the long stock position is restored fully intact. And as I said, there can be a tax advantage to doing it this way. Your stop's only valid when this market is running, but your put, in this case, always out there protecting you. If you look at this stock, and this is a really old chart, but if you look at it, you see those gaps. You're protected. Those were earnings gaps, and you're protected. Once again, in the example, and again, this is an older example, but it works, so let's just go with it. If you want to protect against, sorry, I'm trying to slide this over here. Protect against this trading lows. You buy the diamonds are trading at 127.79. What would you do in this example? You go out and buy the Jan 09 112 puts, protecting yourself at $6.50. On January 15th, 3 or 4 months later, the diamonds have crashed, trading 82.18. Well, our January 112 puts are now trading at $29.82, giving us a profit of $23.32 per option, or $2,332. So we protected ourselves by owning those puts in this example. We established the put position to protect the breakdown. We bought the January puts, $6.50 for each that we bought. You would vary the hedge based on the size of the portfolio you were trying to protect. And at expiration, the diamond's at 82, the puts worth 29.82 help you offset the loss if you held it in the underlying. So your total profit on the option, $2,332. So you would use that to offset the loss you would have had in your underlying by using those protective puts. Again, you can move in and out of those relatively simply. Income generation. Income generation is not possible with only stock. You can sell options strategically that can provide an additional source of income. Some of you may have heard of covered calls, which is you own a stock and you sell an equivalent number of upside calls, generating, hopefully, that the stock doesn't move and you get to keep the profit of the premium that you sold. Again, the key to this being you want to make sure that you sell no more options than you have stock, just in case the stock takes off and your calls get called away. You have the stock underneath it to protect your position. The difference between a call, a buy right, and a covered call, some people will talk about those, and they are effectively become the same position. Just a buy right is a position established where the buyer buys the stock and sells the call as one trade, rather than the risk of buying stock and then executing in the market. So the decaying premium on these sold calls can add to your monthly income. So if you, making up a number, if you were able to sell an upside call for $2 on a stock and sell 10 of them every month, that would be $2. And let's say for 10 months in a row, nothing happened and you never got your stock called away and you got to take $2,000 in profit. Well, that puts $20,000 into your account. And if your underlying 1,000 shares of stock would move down $20 after 10 months, you would have at least offset some of that loss by generating income while it was sitting and not moving to the upside. Again, it may not fully protect you, but it can provide some limited protection if the stock moves against you. These are basic strategies, but there are several ways you can use stocks to generate an income. And the last one we're going to talk about is the ability to cancel market noise. I think the most important thing you have is that you get a little patience. Patience is a lot of times in short supply for traders, for parents too, but for traders. And I think that the ability to wait out a position that you feel is going to go your way without the immediate risk of losing all of your capital, that nagging feeling we've all had when you're in a position and you want to take profits but you think you shouldn't, but you're worried that you should. This patience allows you to be a little bit more calm, allows you to wait, allows the trade to play out, allows the trade to breathe. And sometimes as an equity trader, that's just not something that's afforded to you. It also helps you maintain a positive psychology. You know what your risk is. As a trader, as a person, I always look at, like, what's my worst? What's my downside? What's my worst case scenario? And I look at that all the time. And the ability to know going in your risk parameters very clearly, where are you going to get out? What is your plan? And what's your max risk? Those sort of things really, really benefit traders. I'm a big believer that those sort of things are important to becoming a successful trader. And again, you want to use the model to your advantage. Time can be discounted. You can find ways to use the quiet of the market to your advantage, and it's the result of the options pricing model. And another one, you don't want to be a tick watcher. And what it really allows you to do, particularly if you're somebody who wants to trade more of a swing trading using options, it allows you to get away from the screens. I mean, I'm a person that stood probably for 10 years staring at every tick of every stock I traded. And I'm telling you, it can drive you nuts. I mean, you watch the stock move and tick and tick and tick and tick, and you see things. It's like trying to trade on a 1-minute chart. If any of you ever try to do that, it will drive you nuts. You need to be able to dial back and gain a little perspective. And the ability to have your risk defined allow you to maybe not necessarily be as absolutely critical to get the perfect entry position. You have a little bit of room because you also allow yourself to not get stopped out. I mean, we've all had it happen. You're in a position, you think it's going to go up, it trades down, hits your stop, and what's the first thing it does then? It goes right to the moon. And you're all shaking your head going, yeah, I know that happens. Well, with options, you get a little bit of patience. You're not watching every single tick, and the ability to get away from your screen, live your life, I think is an important thing. You know you have protection. You put your stops, you put your limits in on your options. Where do you want to get out? Where would you want to get out of, if you want to sell to the downside, you wouldn't necessarily always ride every option either to zero or profit. But it gives you the freedom and the ability to walk away and not be stuck to your screen watching every little tick of the market. And you also have the ability to scale in and out with options. Options allow you the ability to scale in and scale out And it's really a big advantage. You can buy in small and add to winning positions, flexibility to roll profits forward, to make other trades. It's again, it's a three-dimensional versus two-dimensional trading experience. So we covered the capital efficiencies, we covered the superior alternative to shorting stock, limited loss, additional means to profit, position integrity after profit taking, timely and flexible portfolio protection, income generation, and the market noise neutralization. I'd like to thank everybody for joining us. I'd like to offer each of you the opportunity to join our cyber trading group. We're running a special promotion. If you reach out to our educational advisors at 877-70-CYBER or 516-280-5350, tell them you're on the webinar with me this evening. You're going to have the opportunity for $29 to join our cyber group for 10 trading days, 2 full weeks. If you really are serious about becoming a stock trader, there's nothing better than watching people who do it well, and that's our team. Screens are up. So it's not there. Screens are up. You get the 2 meetings a day. You get access to the archives. It really gives you a live look at how people who are making money trading stocks do it. I would encourage all of you to do that for $29. You get 10 days, 2 weeks with us. So make a call to our Cyber Trading University educational advisors at 877-70-CYBER or 516-280-5350. I appreciate everyone joining us this evening. This is Greg McDermott for Cyber Trading University signing off. Everybody have a great evening.